In this video, we are going to do a deep dive into what it takes to raise funding for your startup. And we are talking about every round from pre-seed to seed to A plus rounds, B rounds, C rounds, going public, all that good stuff. We're going to cover all of them. I'm going to show you how it works using this blueprint. This blueprint is going to help you understand what it's going to take to build all the pieces and make sure that you've got some idea of a plan of what to expect and what to do if you want to secure funding for your startup, especially at those stages. Before we continue, my name is Ed Kang, and if we've met before, use the chapter marker, jump right ahead and get right into the video. I made it as easy as possible for you. You are welcome. If we haven't met before, I'm a 7-time funded founder with 2 exits, and that's just a fancy way of saying I failed a bunch of times to your benefit because I like to use videos like this and my YouTube channel to help founders, especially early stage founders raising capital, avoid some of the catastrophic mistakes that I've made. Not to say you're not going to make mistakes, but I'm going to try to make your life a little bit easier. I'm also the Chief Strategy Officer for Startups.com. If you're joining us from there, thank you so much. Appreciate you. While you're here, do the like, comment, subscribe thing. Let's jump right into this video. The first thing that we need to do is establish the foundation for what you are going to be doing in the future. And the foundation is so important because there you'll start to make some serious decisions to affect the rest of your fundraise. And it starts with something called funding founder fit, because this is where you are going to decide what type of funding that you need. Because so many founders just go straight into, hey, I need VC, but there's so many other forms of funding. And I spend a lot of time educating founders on those alternative forms because not everything is going to work for you. Not everything is a fit for you. So you have to do some soul searching and figure out, okay, wait a second, what works for me? Here are the options that you have. You've got bootstrapping. Let's say you just want to fund your own startup. You don't want investors. You have the ability to do so, or you're just going to generate revenue. Well, it's much better to sell a company for, like, say, $10 million where you own 100% of it, or go out and try to build a company that's worth $100 million and sell it for $100 million and own less than 10% of it. So much more stress. You know what? Go out and sell a company for $10 million. That's what bootstrapping is. Gives you the maximum autonomy. Then after that, you've got friends, family, associates, or traditional investment. These are investors that aren't looking for the outsized returns, the hyper growth model that we see in VC. They might be banks, SBA loans, a rich aunt or uncle. They all qualify. There are so many investors out there that are just willing to give you money and say, you know what? If I can make 10%, 15% on my money, and then you sell and I double my money, then I'm going to be happy. Way less pressure. And a lot of founders don't consider the traditional friends, family, and associates, and also generous angels, or the traditional forms of capital, such as debt. A lot of great startups have been bootstrapped using FFA, and that might be for you. Then after that, we have our private equity. You have to understand, private equity is different than venture capital. In fact, venture capital is a subset of private equity. It is a subset focusing on alternative assets, which happen to be tremendously risky. There's a whole world out there of private equity where people will come and buy your company and piece them together with other companies, or they're not expecting you to go massive unicorn with this huge exit with $1 billion acquisition or going public. They might be happy in just giving you a 5 times valuation of your top line revenue because they're going to go in, inject more capital, make it part of a portfolio, and they just want to run it as a great annuity type business that returns for investors every single year. Private equity is the bigger umbrella. And if you're a founder, you've never heard of the difference between private equity and venture capital, you would serve yourself so well in going and researching the difference. I know startups that could not get VC, but have exited quite well to private equity. And I played with private equity a lot, working with senior family trusts and different forms of capital coming together. And then, of course, you've got your venture capital. And venture capital is this subset, like I said, where they need you to do a massive exit. They need a huge hit. They'll make like 30 bets in a year, and they only need 1 or 2 to go unicorn to make it work. That's the reason there's so much pressure when it comes to venture capital. I want you to stop thinking that VC is your default. Just because you read some press, just because you heard other founders talk about it, VC is not the end-all be-all. It is not validation that your startup is going to succeed. It's not validation of you as a founder. It is just a tool. Many companies fail after securing venture capital. What a lot of founders don't understand is that the majority of startups are not funded. Majority of them just go out and bootstrap, or they go out and generate revenue. You're only talking about maybe the top 1%, 2% of startups will get funded by VC. And out of that, only 10% will succeed. And out of that, only 1 or 2 or 3% are going to go unicorn. That is the rate of failure. So do yourself a favor and stop and think about, what would my life look like? How would it fit my goals with each of those types of funding? Bootstrapping, what would it look like? Don't just write it off, just legitimately think and say, if I bootstrap, what would that look like? What would that entail? How would I feel about it? And then you can keep going and say, what about FFA? What about traditional? What about loans? And then you can move on to private equity and do some research there. And then think about venture capital. You might have one of those ventures that needs VC. I get it. You have to grow hyper fast. You have to go out there and get as much of the market share as possible. You need oodles of capital to build and dominate the world. If you're building that type of startup, yes, that is funding founder fit for you, but the majority of you out there are not going to need it. And that's where I want you to do a gut check using this blueprint and say, what is my foundation? What am I building on top of? Based on that, you're going to have certain building blocks that you then have to put on top of the foundation. The first one is called founder problem fit. And that's where you have to decide if you have enough domain expertise depending upon the type of funding that you want. If you want venture capital, you're going to need massive amounts of domain expertise because VCs invest in teams and founders. They don't just invest in products or ideas. Now, let's say you just want to bootstrap, which is totally fine. Then the requirements of founder problem fit are less in the eyes of other investors. I'm not saying you don't need domain expertise, but you need less. Case in point, I am not an expert in video games, yet I am funding a video game startup. It is my own passion project. I'm learning my domain expertise as I go. The requirements are way less than if I went to a VC that needed me to go unicorn. They're going to expect me to have so much more domain expertise, so much more experience, probably win awards, have already had other famous video games, successful video games that I've exited. I just don't have that. Yet I want to work on that startup. And since I'm bootstrapping, well, guess what? Founder problem fit is okay. It's not that huge of a hurdle for me. But the further you go up the chain, let's say you go talk to friends, family, and associates. They're going to want to know that you know how to solve that problem, that you know how to go out there and work in the company, or at least you're learning. Sometimes you just go get a certification. Let's say you want to buy a franchise. They're going to educate you, put business in a box, and that's the difference depending on what type of funding that you want. Remember, the foundation will determine everything. So if you don't have enough founder problem fit, that domain expertise that'll make those investors happy, you're going to either have to lower your expectations or where you're going to go get that capital, or you're going to have to go work on that domain expertise. And that might take you some time, and that's okay. I know a lot of founders that went and they just dove right in the problem, right in the industry, and they gained the domain expertise to go out and get that funding from legitimate investors, professional investors who want to invest in startups with expert founders. Then after that, it's something called problem solution fit. And this is where you have to demonstrate that you have actually solved the problem. And normally this requires an MVP and it needs to be validated. You've gone out and you've talked to customers, you built that widget, you built that minimum viable product, doesn't matter what it is. It doesn't even have to be the actual product itself. Could be a landing page, could be a demo, but it's validated. You are going out there and you're saying, hey, customers actually believe that I'm solving their problems and that my solution fits their problem specifically. It's unique enough. Maybe it's a little contrarian. It stands out. You have the unique value proposition down where you are showing investors, yes, I have problem solution fit. This is why I tell founders all the time, go out and start selling your solution from day one. Even when it's an apple in your eye and it's just an idea, go out, do an idea validation deck, an elevator pitch deck, and start selling it because investors are going to want to know. And the earlier you do that, the better it looks for you. Now, remember, if you're bootstrapping and just doing it yourself, great. You don't have that same level of requirements. But if you go to a venture capitalist, VC money, they are going to want oodles of validation. Think about what's happening with AI washing today. Anybody can go out and demonstrate that they can put together an AI, put a wrapper around a GPT model. Great. Now investors are saying, go out and talk to a customer and tell me what they say. What are they looking for? Problem solution fit, that your MVP is being validated with actual customers. After problem solution fit, you are going to get to founder market fit. This is another fit that so many founders ignore. And what are we looking for here? Channel sales. I'm talking money, sales, that you're able to pick up the phone and that you're able to go out and sell the solution to a market that you are connected with. Here's how you know you don't have founder market fit. If you don't know anybody to talk to in the industry, think about this. How many founders go out there and they say, okay, I have expertise in something and maybe I've worked as an expert in the solution, but now I have nobody to talk to. Nobody wants to talk to me. I have no industry contacts. I can't just pick up the phone and say, hey, do you want to try my stuff? Instead, they have to go out and buy their way into the market. They have to spend on advertising. And let me tell you, investors do not like that, because all you're doing is you're just building up debt. There's so much debt that lines up that you have to increase the level of ROI, the ROAS, return on ad spend. And that's not what investors want to give you money at this point in time. They don't want to give you money to figure out how to go to the market. They want to give you money to pour gasoline, because your market is already churning away, that you're already making that money. That froth is starting to happen. So here's the test. If you can't go and write down 200 names of people remotely associated with the industry that might want to buy, know other buyers, or give you feedback, then you don't have founder market fit. You can care about the problem all that you want, and that is a reality that investors are going to look at, because these days it's very easy to develop products. Distribution is fragmented and it is very difficult. But guess what? Like I said, if you're bootstrapping, I'm going to keep being like a broken record on this. If you're bootstrapping like I am with my video game company, I don't need to have all the connections. I can go out and slowly pick my way through, develop my name, and start to develop that market fit in a way that is commensurate to the amount of capital that I need. But if you're looking for a VC, you need oodles, gads and gads and gads of founder market fit, and you have to be able to demonstrate that right out of the gate, which relates to your domain expertise. If you got lots of that, you probably have a lot of founder market fit, a lot of contacts in the industry, and the investors trust that you can go out and start selling right away. So each one of your contacts becomes a potential sales channel, or will lead you to that sales channel, because investors are going to be looking at it. They want to know what's your go-to-market strategy, not a bunch of laundry lists of tactics saying, I plan to go viral and do social media. No, they want to know the strategies that you have in place and what you've been proving as far as the channels that you've opened up for that founder market fit. Now, after all that, if you've got founder problem fit, and you've got problem solution fit and founder market fit, then you have the best chance to go out and start proving that you can get product market fit. And product market fit is more than just someone bought your product. Remember, we've taken care of that already in the previous 3 building blocks. What I'm referring to here are your traction metrics. Are your metrics showing the level of growth that investors at that stage need to see? And the type of investor, if you're talking to a VC, they need to see substantial amounts of traction. We are talking about 10% week over week growth, and you're leading yourself to that almighty break-even point, default to live, and eventually that path of profitability. But all the signs are there. The traction is there. And it's not just you made $1 million, but you made $1 million over the past 6 months, growing 10% week over week. And that trend is starting to continue, so that when they pour gasoline on that fire, give you that capital, then they can calculate out and predict your chances of success. When you get to product market fit, it's pretty much your game to lose, because this is so difficult to obtain. In other words, your metrics are going up and to the right over a period of time, and therefore investors are going to be very bullish, and that's when they really get that FOMO. They fear of missing out, that they're going to miss out if they don't get in as early as possible. So the sooner you can show product market fit, the sooner you can get those VCs involved. But one more time, if you're bootstrapping, product market fit is not that important. Why? Because you don't have the same requirements for sales. You don't have the same hyper growth targets to get you to the next round. You may just be growing 10% month over month or 10% year over year. A small business that grows 10% year over year is a really good business. And that might be the business that you're trying to build. It's a concept that I call unicorn, YO unicorn, versus the other Wall Street IPO unicorns that all VCs want. Build something that's just good for you, and product market fit, that goalpost, those standards change and can become much easier and much more fulfilling. But as always, product market fit is going to make raising capital or getting that loan very easy at all levels. So you want to be getting to product market fit as soon as possible. That's the reason startup founders and investors, everybody talks about it like it's the holy grail, because it is. Now, the last building block that you're going to get to is something called business model fit. Now, at pre-seed and seed levels, business model fit is not as important. You have to be pointed in that direction, and investors want to know that you've thought about it, and they're going to be thinking about it too. What ultimately is the business model? Especially if you got a major big market that's got billions behind it. They're looking to get you to scale to profitability. If you can't be profitable, you're not going to go public. The public investors, the shareholders, are going to look and say, you haven't turned any profit, and therefore your stock price is going to plunge. You're not going to be valuable as far as an acquisition is concerned. You're probably going to be doing down rounds, and everybody's just going to feel bad. And that's the pressure that happens when you're working with venture capital. If you're trying to get VC, your total addressable market needs to be in the billions. And to reach that level, attack that entire market and get a fraction of 1% or 2% of it, you're going to need business model fit. The pressure on your business model astronomically increases. That's the reason service companies that do things manually or franchises, VCs don't want to invest in those small business, mom and pop type shop business models because you're never going to scale to the point where you'll get business market fit to that size of total addressable market. But let's say you're working with friends, family, and associates, and you can just do a nice business model, like a franchise model. You buy a Subway and it just returns amount of money and you say, okay, in 5 years, I'll pay you back plus a nice healthy return, or I can sell the Subway and everybody will make 1.5 times 2x on their money. Well, that business model fit is going to be much more conducive for that type of investor. And of course, if you're bootstrapping, you can grow into your business model any which way that you want. It doesn't have to get into billions. You can get into millions and be totally okay. And then eventually someone will still want to buy your business. So remember, your funding founder fit will determine eventually your business model fit, because you are going to have to find the right business model to grow into that size of market. Think about it now so that you're not totally shocked later. I have founders that have come to me and they've said, you know what, Ed, we've realized our business model isn't going to scale and we're not going to reach that TAM. And I have to go to investors that are expecting us to do 10x, 15x, 50x returns and say, hey, would you be happy with a 2x, 2.5x, 5x return? And those conversations, if you're talking to VC, do not go well. But if you're talking to angels or people who are just traditional investors, well, then that's going to be okay. So prepare yourself now so that you save yourself a lot of headache and a lot of heartache in the future. Now that you've got this blueprint, you've got the foundation, you've got the pillars, you will then be able to determine founder investor fit. And not all investors are going to fit with you. And that's where a lot of founders then get right up to that point in time and they're sorely disappointed because they've worked so hard in getting their business models up and running and their products selling and getting that traction, and they show it to investors. And here are the things that occur at this level that disappoint founders. It's not a fit for you between you and the investor. First is the stage. If you're not approaching the investor at the appropriate stage, let's say you're going out and you've got seed level traction and you go talk to an investor who only invests in A rounds, well, then that's not going to fit. Well, that's an obvious lack of fit between you and the investor. But next comes the check size. How much are they willing to write? Let's say you have to go out and you have to raise $2 million to make sure that you're able to implement your model, but you're talking to an investor that can only write you a $50,000 check. Well, that's not a fit. There is a disconnect right there. And guess what? If you can't use $50,000, then don't take it, because you have to go out and raise that amount of money. I have founders that we have helped get meetings with angel investors, and they can only write those $50,000 checks. And they say, Ed, we need millions of dollars to complete our massive hardware, our install. And I go, we can't talk to those angel investors anymore. We have to go right to VC. But now you got a chicken and egg scenario because the VC say, where's all your traction? It's tough. And that's where you might have to adjust your plan, what you expect to be able to pull off. The next consideration are the terms. Some investors, especially when you get into the VC levels, they want massive control. They may only have 10%, 20% of your company, but they're going to have the final say on hiring decisions, on your compensation, of strategic direction, sit on your board. Guess what? The amount of money and the amount of ownership does not necessarily equal to the type of control that they have. A lot of investors will come in and they will dictate the terms, and you will lose a ton of autonomy. And that's why I don't like working with investors. I hope I never have to have another VC, another angel, another external investor in any of my ventures for the rest of my life. I choose to work on the ventures in my portfolio based on what I'm willing to fund, because I don't like losing my autonomy and I don't like giving away terms. Remember this, the more money that you take, the more terms you're going to have to give away. But if you want your own terms, take less money. That's just a big generalization. Obviously, if you're sitting on a unicorn, you're Mark Zuckerberg, Elon Musk, you can determine a lot of different terms and get all that money. But the chances of you doing that and being there are very slim. Let me know if you are. I'd love to work with you. And the final thing that many founders don't consider is the exit. What type of exit does the investor need and want? Like I told you, some traditional investors are just happy with a check, an annual return every year of 10, 15%. And they go, I'm just going to ride this for the next 10 years. Maybe if you exit, then write me a bigger check. But then if you have VCs on your cap table and they have a portfolio, they take a portfolio approach, they have to push you to an exit because 90% of their ventures are going to fail. And that's where there are certain terms where investors, VCs, will actually drag along your other investors, maybe the early ones, the angels, your friends and family, and let's say, no, we're forcing you to sell, or we're forcing you to dilute, or we're forcing you to take this capital. Because if you don't, then you're not going to generate the returns. And so something that might have been a great lifestyle business that comes out with a very healthy exit for you that fits your goals, it's that YO unicorn, that may not jive. There is a disconnect with the incentives of that venture capital. And so many founders are absolutely shocked. Private equity will do this as well. They will grind you down and say, you know what, we're going to hack 20% of all expenses, 20% of all the staff, and then we're going to inject and we're going to make you work towards profitability and change your life. And it's no longer about changing the world. It's no longer about doing what you're passionate about. It is about making money. And that's the exit private equity wants because they're putting together a portfolio. They need to give those returns for the investors, and that changes depending on what type of investors you have. Especially if you're bootstrapping, you don't have to deal with that. So take a look at this entire blueprint and go through every single box and think it through now before you are shocked later on. You want to start with funding founder fit and then work through every single one of those pillars and ask yourself those questions. Do I have domain expertise? Is my MVP validated? Do I have sales in certain channels? Are my traction metrics going up and to the right to that exponential expectation investors will have? And do I have the right business model in mind? Will I be able to scale to profit? And that's going to lead you to talk to dozens, if not hundreds of investors to find that founder investor fit. And you have to ask yourself, are we ready for that type of journey? Here's the encouragement. I believe every founder has a better than 0% chance in building a successful startup, and if you need it, raising capital, but also have the potential to be your own investor to bootstrap. But you have to be realistic. Use the blueprint to say, what type of startup am I building? Is it a fundable startup? Because blueprints help us build structures. There's nothing worse than building a structure on a crappy blueprint and then having it all fall apart. All the codes are not up to snuff. It's dangerous for everybody involved. This blueprint is going to help you develop the right foundation and plan every single step so that you can approach your fundraise with comfort, with confidence. And confidence is so important because investors can see that a mile away. Hope this has been helpful. Watch some of the other videos that I put on the screen. For those of you out there who've been patient, I had to take a couple weeks off to work on one of my own ventures that I'm self-funding. I'm using this blueprint for, but it's super exciting what's going on. I hope to let you know and share good news in the future, but thanks for being patient again. I'll see you in the next video.